Today, we're diving into a hot topic that's dominating headlines, lighting up search engines, and sparking serious debates across the financial world. Yep, we're talking about the debasement trade. It's been bubbling under the surface all year, but lately it's exploded into mainstream conversation, just as gold prices take a sudden tumble last week. Perfect timing, right? In this episode, we'll explore what currency debasement really means, why it's back in the spotlight, and how investors are thinking about real assets, financial assets, and the strategies that just might protect their portfolios when the money itself starts to come into question. If you'd like to read the full piece with all the charts and extra details, check out the link in the description. Alright, let's get into it. So what's all the fuss about? The term debasement trade isn't exactly new, but it's certainly enjoying a revival. Mentions of it in financial media have surged recently, and Google searches are following suit. Not surprisingly, it seems to be moving in sync with gold, silver, and Bitcoin prices. Which begs the question, are investors chasing gold because they're worried about debasement, or are they talking about debasement because gold is flying? Let's break it down. Currency debasement is essentially when a currency loses its value, similar to inflation, but often more intentional. Back in the day, kings and emperors literally shaved off bits of gold and silver from coins or mixed in cheaper metals. The Roman Empire mastered it with a technique called coin clipping. Fast forward to today, and we're still doing it, just with a lot more zeros and a lot less metal. Modern debasement plays out through massive money printing, aka quantitative easing, deficit spending that far outpaces tax revenues, and central banks keeping interest rates low to make debt more manageable. It's all part of a concept known as fiscal dominance. We talked about this back in April, when governments effectively lean on central banks to make their debt problems disappear by letting inflation do the dirty work. Here's the kicker though, global debt levels are huge. The US is nearing 120% of GDP, and as for Japan, it's over 260% of its GDP. So there's plenty of incentive to quietly inflate away that debt rather than face the political fallout of higher taxes or painful spending cuts. And with Trump pushing big spending policies again, the idea that we're heading into another round of inflationary policy feels, well, more real by the day. So some people have raised the question, is this debasement or de-dollarization? And this is where things get interesting. The S&P 500 is up around 15% over the past year, which isn't bad. But if you measure that return in euros or Swiss francs, it drops to only around 5%. But if you use gold, silver, or Bitcoin as your denominator, it's actually down around 20%, depending on which one you use. So yes, the market's climbing in USD terms, but when you change the denominator, the picture gets a whole lot murkier. So this is sparking some speculation. Is this about a weaker US dollar, a broader loss of faith in fiat currencies, or something else entirely? To be fair, the USD's recent weakness could simply be driven by global diversification and shifting interest rate expectations. But the market is sending some confusing signals. Here's some points on the pro-debasement side. Firstly, government debt is surging globally and no one's slowing down. Central banks are incentivized to keep rates low. Real assets like gold and silver are outperforming other assets, and even equities, despite lofty valuations, are grinding higher. Perhaps they're pricing in weaker currencies. And on the skeptical side, you've got the fact that the dollar's been fairly steady since April. Long-term bond yields aren't running wild, and inflation expectations are still pretty tame. But there's always the argument that gold's run might just be momentum driven. When everyone's talking about an asset, chances are it's getting crowded, often with short-term leveraged traders in the mix. So let's talk about defense, real assets versus financial assets. In times of uncertainty or potential debasement, real assets often shine. Financial assets like bonds, stocks, and most derivatives are based on future cash flows priced in the currency. When that currency weakens though, their real value can erode. Real assets, on the other hand, are tangible. Their value is typically tied to scarcity and utility, not to a central bank's balance sheet. That includes the likes of metals and energy commodities like copper and oil, commodity producers who own real reserves, alternative assets like farmland, timber, and infrastructure, and real estate, though REITs can behave more like financial assets due to their interest rate sensitivity. In short, real assets aren't about generating wealth, they're about preserving it. Now let's address the shiny elephant in the room. Last week, gold dropped about 6% on Tuesday, its biggest one-day fall in over a decade. Silver and other metals weren't far behind. Some blame the pullback on geopolitics, specifically easing tensions between the US and China. Others point to low liquidity with Indian markets closed for Diwali. But let's be honest, after a 55% year-to-date rally, a bit of profit taking was pretty inevitable. That said, gold's fundamental bull case is still pretty intact. Central banks are continuing to accumulate it, albeit at a slower pace. It's now widely held, more so than US Treasuries in official reserves, and crucially, it offers countries a hedge against geopolitical risks and the weaponization of the dollar. In a world where financial assets can be frozen, gold's neutrality holds real value. So what's the insight here? Well, you might want to consider hedging your hedge. Gold and other real assets can absolutely be part of a smart portfolio, especially during volatile and uncertain times. But when the story is this popular, it's worth being a bit cautious. Dollar cost averaging into it or buying on weakness can make more sense than going all in at the latest highs. But not all stocks need to suffer from debasement. Some can actually turn out okay. The key there is their pricing power. Companies that sell essential goods or services, those with strong moats and loyal customers, can raise prices without losing business. That means they can protect margins and even grow earnings in inflationary environments. Think of consumer staples like Procter & Gamble or industry leaders like MSCI, companies that weather inflation and can still deliver returns. On Simply Wall Street, you can analyze companies for pricing power by checking their margin resilience during inflationary spikes. If they held steady while costs rose, that's a great sign. And that's where we'll wrap up this week's Market Insights. If you'd like to read the full piece with more details and charts, you'll find it linked in the description. As always, we'd love to hear from you, so send through your feedback, questions, or ideas for future episodes. We'll be back next week with more Market Insights. Until then, invest well.